with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's going crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. We'd like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today, Friday, August 14th, 1982, baby. That's right. Number one song on the Billboard, Man Eater by Hall & Oates. Rachel will like that. She's into the yacht rock radio. Yeah, and guess what? Guess how many barrels of oil we have in the Strategic Petroleum Reserve? 290 million, give or take. 1982. Daryl Hall, John Oates, Man Eater, and 290 million barrels of oil in the Strategic Petroleum Reserve. And guess what we have in common with 2026? Yeah, the Strategic Petroleum Reserve. Yeah, 290 million barrels, give or take. That's where we are, 1982. That's where we are right now in 2026. No one's really talking about it. I think energy has been incredibly resilient as far as not going up higher than what it has. Strait of Hormuz continues to be shut down, and even if they reopen it tomorrow, we've got a problem. But the oil market doesn't seem to be pricing it in a whole lot. As a matter of fact, Saudi and some of the OPEC nations, they're projecting that demand's not really where it needs to be to cause a problem. But I just have to say that this is something that's on my radar. It doesn't look very pretty right now, along with other things we'll talk about in a moment. Let's first jump into the numbers. Actually, before I do that, some big shout outs to Diana, to Mark, to Dale, Pam, all the folks tuning in. We appreciate it. Thank you so much. What about the numbers this week? Well, Dow Jones down a tad this week, down 0.56%. The S&P 500 up a little bit, up 0.36. The NASDAQ composite up a tiny bit, up 0.14. And the Russell Small Cap Index continuing to crush it, up 1.1% on the week. It's up 23.8% on the year. So that continues to be really, really strong. Looking at the volatility index as measured by the VIX, down 4.3%, down to 14.25. Look, I've been doing a little bit of studying on the VIX, the volatility index, and some of the technical indicators there. And I'll just say that it is kind of set up, kind of poised for a spike, probably sometime between now and October. I mean, the technicals suggest it. And then the fundamentals, just the environment that we're in, would also lean towards it because, that is heading straight into a midterm election. And I can tell you that wonky things tend to happen as we head into midterms. You get foreign bad actors trying to stir the hornet's nest, trying to cause things to get ugly, swaying the election results, things like that. Look, just look at the whole Iran thing right now. I tell you, I never like to get real political on this show. You know that. But this whole Iran thing just irritates the crap out of me. First of all, we make the decision to kind of go in and do what we did, this whole punching first type of thing, which I'm just not a big fan of. And then all of a sudden, oh gosh, midterms are coming up and the markets aren't doing so good and oil prices are over $100 a barrel. So all of a sudden we're running backwards at 100 miles an hour. Oh, well, we're going to put economic pressure on you, Iran, if you don't play nice. Well, wait a minute. I don't think this is setting up to end very well. Okay. When I say end very well, I don't mean right now. I mean long term. We go in there, we take out the leaders of a really bad regime. And guess what? The bad regime is still in power. And now we're backpedaling. And I feel it's politically motivated because the midterms are coming up. And look, if you're going to step in it by doing this to begin with, you might as well finish it the right way. I don't think it makes a whole heck of a lot of sense just to piss them off to this degree and let them live to fight another day. Because guess what? They're going to fight another day. So I don't know. I'm just not down with what's happening. And if you're going to ignore the political fallout by starting something. Continue to ignore the political fallout and finishing it. Otherwise, you're setting us up for trouble down the road. It may not be anytime soon. It could be 5 years, 10 years, 15 years. I don't know when it happens, but I don't think you leave these people who just killed their families and stuff like that in power to come at us at another time. I'm not trying to preach here politics. I support a lot of things that happen with the current administration, but I just don't really like what's happening here as far as this war is concerned. And all of a sudden now we're threatening economic sanctions. Really? Okay. All right, we've been dropping bombs all over that country, all right, for months. And now we're going to threaten economic sanctions because they're not playing nice with the Strait of Hormuz. You really think you're going to get anywhere with that? Okay, whatever, man. Whatever. I just don't get it. All right, enough of that. Let's get back to the other things. How about long-term bonds measured by the TLT? Down almost 1% this week. Negative again. Rates continuing to go higher again. On the long end, now the short end performing better. Those bonds are actually up on the week and those rates went down a little bit. Gold was up 0.7%, silver up 1.7%. They were doing pretty well. And we look at the sectors during the week, the strongest performing sector, one that we are double the weight of on the S&P 500 was energy. And it was up 7.6% this week. And a lot of it's because of what I just talked about, right? You've got strategic petroleum reserves down to lowest levels since 1982, and the Strait of Hormuz is effectively shut down, and it's going to definitely cause some issues there with the energy sector. How about other areas of the market? Some of the defenses were shining kind of brightly. Staples were up this week, 1.1%. Healthcare up 1%. But you also had growth areas like technology up 1%. Communication services up 1.5%. So I can't really say that the sectors of the market were really saying a whole lot to us one way or the other, outside of the fact that energy is looking suspect at the moment as far as how things are shaping up in regards to oil prices. And look, I'm dumbfounded. I am dumbfounded, stupefied at how oil remains so low with this dynamic building. And the only reason why the supply-demand issue hasn't become crazy is because globally, all these countries are releasing lots of their strategic petroleum reserves, trying to keep prices down. Well, you can't do that but for so long, and then you're going to run into other problems. So other things are happening in the markets this week. There's a lot of stuff, man. Look, you got NVIDIA out there, okay, pulling together Goldman Sachs and a handful of other high-risk financing enterprises and structuring a credit facility of $500 billion of potential loans to who? To NVIDIA's customers. So NVIDIA's customers can buy more NVIDIA chips. Yeah. What can go wrong there, right? I mean, seriously, does this mean that NVIDIA is now out of money to loan their customers to buy their chips and now they're having to go to the banks to do it? What can go wrong with that? Yeah. Listen, when you're convincing banks and other entities to loan money to your customers so they can buy more of your product, I just think that says something about maybe where we are in this whole scheme of things with this AI build out. So that's going on this week. Does it mean anything today? No. It might not mean anything for 2 or 3 years from now. These things, folks, have a tendency to be irrational for very long periods of time. Things can go much, much higher before the bubble pops and all these types of things. But this is the type of stuff that you see in those types of environments. So it's something to be mindful of. Oh, we crossed $40 trillion in national debt this week. That doesn't mean a whole heck of a lot. The actual number is not as important as its relation to GDP, right? The total production of the American economy. And right now, when you look at debt held by the public, we're at 101% debt to GDP, okay, which is very close to World War II record of 106% of debt to GDP. The only difference is we've got tons of bills and obligations and rates are high and there's all kinds of issues that we are facing in this environment with this level of debt versus that environment with the level of debt that we had back then. We were able to grow out of it pretty well, pretty quickly. Not right now. This is bad. I mean, it's incredibly, incredibly bad. The amount of debt that just ballooned since I got in this business. I mean, look, when I got in this industry, it was somewhere around 20% debt to GDP, and now we're over 100. Japan's been almost 200 for decades, and they're still surviving. So it doesn't mean that we're going over a cliff, but it is a problem when your second largest expense of the whole entire country, only second to Social Security, the second largest expense we have, bigger than the military, bigger than Medicare, The second largest expense we have right now is the interest on our debt. That's a problem. And the bond market's not going to like it. Bond market hasn't been liking it too much. So that's going on this week. That was also another story this week. Look, we had a bad retail sales number this morning. I'm not sure what that's going to mean. We get some retailers reporting next week. We'll see what they have to say. So far, I've seen some pretty good commentary on the consumer. Airbnb, right? I mean, they had a big bump up. They had a great quarter. We don't own that one, but I watch lots of stocks that we don't own. I still watch them, pay attention to what's being said. So really bad retail sales number. It could be chalked up to Amazon pulling the Prime Day forward from July to June. We had a couple inflation numbers this week that were okay. They were a little bit better than expected. Both the consumer price index and the producer price index a little bit better than expected, but still very high compared to where the Fed wants to be. But the market took that as cover for Fed Chair Warsh to not raise rates in September, which is a few weeks away. So we will see if that is how it plays out or not. Should they raise rates? Look, it is supply shock driven. There's a lot of debate to be had about that. I'm not sure they should have cut rates 3 times like they did last year. So there's something to be said about that too. It's kind of hard to weigh in as far as cut or raise. Now, if you can't really determine cut or raise, I don't think it's all that clear one way or the other. Then maybe you just hold. And I think that's probably what's more likely in September, but we'll see. There's a big rigmarole about the market not having confidence in the Fed, that the Fed wants to tackle inflation at the degree that they should. I understand that. I do understand that. This inflation is sticky. There's no doubt about it. But it's also seems to be tolerable because the spending continues. The spending continues. So those are all the things hitting this week. And like I said, we'll have some retailers next week. We had some earnings this week that, again, they continue to be interesting in regards to how the market's reacting to things. One of my friends there, Nick Rake over at Earnings Scout, saying, hey, watching these earnings deltas, watching them close, because if they start to change, the market could have a little change in direction. Looking at lots of technical indicators, talking to a lot of our technicians that we contract with to stay on top of some of that stuff. And in the super short term, the market looks a bit constructive. We were in this, what's called a bullish flag pattern. Looks like maybe we broke out of that to the upside. We also kind of broke out of this 3-month sideways period, maybe to the upside if things hold. But there's some other things looking out next few months that look dicey. And of course, we got that midterm election in front of us. So we'll be paying attention to all of that. But then from October until the following year, things are kind of setting up to maybe look pretty good. So we're going to keep that in mind if we get a big enough drawdown to take advantage of it. For all you new folks trying to put your money into places within the models that have been just kind of not overperforming at the moment, staying away from the stuff that's been screaming and it's been super hot, waiting for maybe a little bit of a pullback there to put your money into those places. But as far as the models are concerned, folks, I love where we stand on things. We've got a great diversity across the models. Whatever comes our way, I feel very confident we can handle it. And that's where we want to be right now because I just think that it's hazy. I think the visibility looking forward is hazy at best. And everybody on the street, everybody is bulled up. B-U-L-L-E-D, bulled up. They expect big things from Mr. Market. And when everybody is on the same side of the boat, I get a little concerned about that. And the thing is, here's the other cautionary flag about that. I kind of agree with them on some issues. I think from the midterms into next year, I think things could be pretty hot. But that concerns me too, because I'm finding myself agreeing with the crowd, and I hate that. So we're going to stay disciplined. We're going to keep our balance. We're going to keep our diversity. Going to keep our hedges in place. Continue to do what we do and look for some opportunities. Let's keep crossing our fingers and hope that gold comes back down. I think it will. Looking at some of the technicals, and maybe we can step into that and add that back to the mix. All right, I'm going to wrap up. Between now and next few meetings, you're thinking about your future and long-term goals, all the things you want to do with you and your money. Maybe it is buy that beach house or condo down there at the beach or at any beach. Maybe it's not down there. When I say down there, I'm always referring to those Delaware beaches. Maybe it's further south than that. Maybe it's Florida. Maybe it is the Caribbean. You know what your goals are. Don't just think about it. Think big. Think B-I-G. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.